Hi there. I'm verified champion trader Kevin Davey, and today I'm going to talk to you about the risk of ruin and why it matters. So let's get started. Before we get started, if you haven't signed up for my free Algo strategy, now's the time to do so. Hit the QR code or enter the link you see at the bottom, or in the description, you'll find a link. Sign up, you'll get this free algo and lots of other great information. Okay, so today I'm going to answer the question, what is the risk of ruin? Because you hear it a lot, hopefully, in trading, but you may not know what it is. So I'm going to give you some examples and talk about it a little bit to help you out. The key with the risk of ruin is when you avoid ruin, you survive. And sometimes that's the most important part of trading, is just surviving. And the risk of ruin can help you identify, hey, am I likely to survive or am I likely not to? So back to what is the risk of ruin? The easiest way to explain it is by doing a coin flip game, okay? So let's just say we had a biased coin where you flip it, and instead of 50-50 heads and tails, it's 60-40. 60% heads, 40% tails, okay? And let's just say when you bet, you're always going to bet $1. And when you win $1. Of course, when you lose $1. All right? Pretty simple. And you might say, well, is this a game worth playing? Well, you can kind of figure it out just by looking at the 60-40, and you say, yeah, that's definitely a game worth playing. But let's do the math. So 60% winning percentage with $1 wins and 40% losing percentage with $1 losses means your expectancy is 0.2 per flip, or 20 cents per flip. So that will be your average return. Okay? And if 20 cents is your average, after 5 flips, you'd expect to be up $1. All right? So that's what your equity curve looks like. Upward to the right, no drawdowns. That's the average, right? But, of course, with the randomness of the coin, it's not going to work out that way. But you'd play this game all day long, right? Everybody would, because in the long run, you're going to win. But now, let's add a few twists and see what happens here. Okay? I mentioned the first twist already. Talk about coin flips being random. And since there's randomness in it, it could be good luck, could be bad luck. But it's not going to be that straight equity curve that you're hoping for. It's going to bounce around. And you'll never be able to duplicate that average curve. Well, I mean, maybe if you do millions of tosses, you're going to be really close to the average, but it's still probably going to bounce around that average curve, above it sometimes, below it sometimes. It's never going to have an extended run where it's right at that average. All right, so the average right here is shown in the thick blue line, and then I just plotted one run of 25 flips. I did 25 flips. That's what the equity curve looked like. In that case, you got lucky. All right. But then the same thing could happen with the same coin in the red curve. You got lucky the first time, but you got unlucky the second time. And this all relates to the risk of ruin. Okay. Because you could have all kinds of different outcomes based on the randomness of this coin flip. And the point here, even when you take it out to lots of flips, like I said, you're never going to be exactly on that curve all the time, but you're going to bounce around. Sometimes you're above, sometimes you're below, but eventually you get close to the average. But that takes a long time, and you can deviate quite a bit from it. And that's where the risk of ruin comes in. So that's twist number one. It just shows that randomness. You can be lucky, you can be unlucky. And if you have a limited bankroll, well, what happens if you get unlucky? Well, you get wiped out. That's what you got to watch out for. So twist 2 is we're going to define that bankroll. So you don't have unlimited money. Obviously, if you had unlimited funds, you'd be able to trade through any kind of drawdown or any kind of unlucky period. But if I force you to come up with a bankroll, well, if you're unlucky, you could lose it all, right? Let's just say you said, hey, I'm going to start with a bankroll of $1. Well, if that first flip works against you, you get wiped out, right? So you want more than obviously $1 to start here, but the more money you have, the less chance you have of getting wiped out. So the question then becomes, how much do you actually need to be safe to play this game? Okay, so let's take a look. So if you start with a $1 bankroll, you have a 40% chance of being wiped out after the first toss. And because that was the percent against you, so that first toss, you have a 40% chance of getting wiped out. And after 3 flips, you have a roughly 50% chance. And you could do the math for this because it's a simple coin flip game, but you can also use a Monte Carlo simulator, which is available on my website. Now the flip side to that was $1. Let's say you started with $1 million and you're still betting $1 each time, but you have $1 million bankroll. You basically have 0 chance of getting wiped out. Now it's never quite 0. It's always going to be some real 0.00001 chance of getting wiped out depending on your bankroll. But with $1 million, more or less, you can pretty much say you're never going to be wiped out. Okay. Well, if you'd like more information on algo trading, hit the QR code. It'll take you to Amazon where you can look at my 5 trading books. So let's just look at, after 25 flips with different amount of starting equity, what your risk of ruin is. You have a 63% chance if you start with $1 that you're going to get wiped out, meaning you're going to go to $0. And when you're at $0, you can't place any new bets. And then if you're up at starting with even $10, you've reduced your risk of ruin from 63% down to about 1%. Okay? Now this is easy mathematically because it's a coin flip and you know the odds. And obviously when you're looking at trading strategies, it gets a lot more complicated, but the same thing holds. You're going to have a certain risk of ruin with a certain starting equity. Okay? And that's how it applies to trading. And that's what this is all about, right? So I've spent the last 6 or 7 minutes talking about coin flip, and you could be like, well, okay, that's coin flip. Who cares? This definitely applies to trading. And what you've got to remember is you've got to start with a certain bankroll that's going to minimize your chance of risk of ruin. The flip side is if you start with way too much money, your returns are going to be kind of low. So it's a balancing act. And you'll see I have other videos on risk of ruin and how to work all this, but I think you get the general idea. If you start out with too little of a bankroll for what you're trading, whether it's a coin flip or a trading strategy, you're going to run into trouble. So keep the risk of ruin in mind. And remember, the reason it's important is because trading's just a random game. And even if you had a strategy that made money, remember I had the coin flip that made money, it was a positive expectancy game, you could still get wiped out. And a lot of people don't realize that with a trading strategy. You could have a winning strategy in the long term, but if you don't have enough money to survive the drawdowns in the short run, you're going to get wiped out. So keep that in mind as you look to trade. Hopefully this video helped you out. Take a look at my YouTube channel for some other videos on risk of ruin. I'll be adding them over time. Leave a comment. Let me know how this worked out for you. I'm Kevin Davey. Have a great day.